Hi, my name is Ishmael and today we're going to be talking about capital gains tax and ways you can reduce it. So what is capital gains tax first off? Well, capital gains tax is when you buy a property, say for £100,000, and you either increase the value or you wait a period of time so the property value goes up and you sell it. Say you sell it for £150,000, so you've sold the property for £150,000, so your profit is £50,000, so you would pay capital gains tax on that £50,000. Now how do you reduce this, or how do you stop paying capital gains tax? Well, you have capital gains tax allowance, which is just over £10,000 a year. So if you haven't used this yet, you can always put the capital gains tax and offset against the £10,000, which means you don't pay capital gains tax on that £10,000. Now, that's one way of doing it. Another way is to adding all allowable expenses. So if you're getting a good accountant, you can have various different expenses put against the property that you may have spent money on. So if you had the property for a period of time, or if you just renovated it, you can put all the renovation expenses against it. And if you've had it for a period of time and you have to do maintenance over time, then you can put all these expenses against it. Now you will have to double check exactly what expenses you can put against the capital gains tax with a qualified accountant, because I'm not a qualified accountant, so I'm not giving you any official advice. This is just my recommendations. A second thing you can do with regards to capital gains tax is you can, rather than selling the property, you can refinance the property. Now obviously if you want to sell for various reasons, it's not the same, but another way of getting around paying it at the moment would be to refinance the property. You still get a percentage of the cash, so you can refinance up to 75% of the new value, taking some of the extra cash out, or 75% of the extra cash increase out. So you would be taking out £37,500 out of the £50,000 increase in the property value. So this is another way, and then you can use that money to invest in various different properties if that's what your strategy is, and you can spread your portfolio over multiple properties rather than having all the cash in one property. Now you have to be careful, because as you become a larger landlord and have more properties, you will have to look at your portfolio leverage. And I would recommend, a lot of landlords are saying, and a lot of gurus, so-called gurus, are saying that you should just leverage and go up to 75%. Now that's all fine, as long as you don't have to remortgage in a period when there is a recession. There's talks of a recession coming. Whether there is or isn't, it doesn't matter. There's normally a recession every 10 years or so. If we are in one, if we have an issue, and if we're not in one, there will be one coming. So for example, in 2008 when the recession came, there was a 10% drop in house value. Now if you'd mortgaged just before, on say a 2-year fixed term mortgage, then you may have come across, when the mortgage term ended, you either had to default onto the higher rate, or you would have had to then go off and end up with not having the full 75% loan to value, and therefore putting your own money in, and this is obviously not what you want to do. So I would recommend bringing your loan to value down, if possible, to 70% or 65% ideally. That would allow for any market movement, and if you keep it at 65%, your portfolio is safe. Also, when you're going to large portfolio landlord, when you start getting 5+ properties, 10+ properties, then the banks look at your portfolio as a whole, not individual properties, and they'll look at your portfolio income and your portfolio leverage, how well the properties have been performing, and how well your company or your entire portfolio is performing. So you need to think about this if you're planning on going for a long-term investment strategy of becoming a full-time landlord with multiple properties. So I would suggest trying to keep your leverage down, loan to value of your mortgages down to 70 or even 65. Over time you want to bring it down to 65 ideally. So if you like this video, please subscribe to my channel, whack that bell notification icon to get notified of the next video coming out next Tuesday, and enjoy.